The delicate balance of risk and rewards. We have been going through very volatile times as far as Indian financial markets are concerned. And one of the things that we always find is it does create its own stresses for investors. One of the important things to keep in mind is that as you choose better rewards and higher returns, risk goes hand in hand. And finding the delicate balance between the two is very, very critical for investing success. Today, we'll talk about a few items that we've learned over the years that are crucial to find this risk and reward balance. Number one, understanding your risk tolerance and having a clear investment horizon. Invariably, we found that if investors are not clear about how long they want to invest for, whenever risk arises and comes to the fore, it creates a lot of stress for investors. One of the best ways to deal with this is to be very clear in terms of how long you want to invest for. Because then what happens is volatility along the way can actually be your friend rather than your enemy. S. Naren, an equity market veteran, recently created a lot of flutter in media because of mentioning that he thinks investors are at high risk unless they're really invested for many, many years from a longer term perspective. I think this statement actually came out and gave investors a clear understanding that the same volatility may actually be okay for an investor who's a very long term investor, but for an investor who's trying to make some short term or medium term gains, equity market valuations, especially in certain segments of the market, may be a little bit of a concern. Number two, think carefully about countercyclical investments. Countercyclical investments essentially are about going against the herd. While this sounds very simple in theory, it's very difficult to implement in practice. Think about how easy it was for you to actually exit equities a year ago when they were on fire. And think how difficult it is for you today to invest in equities when equity markets have fallen about 20% from their peak levels. We don't need to be countercyclical just for the sake of it, but we do think that by using countercyclical strategies, where maybe returns have not been as high in the recent past, or by looking at multiple asset classes in a portfolio, it's a very, very good idea to manage risk and return. Number three, do what banks do. Asset liability matches. In very simple terms, what this essentially means is that look at all your cash flow needs over the next 3 to 5 years and see whether you have that in assets which are safe and not going to be linked to how markets do in this period of time. For example, go back to 2023. At the start of it, you suddenly started to see markets lose a lot of value. And if that coincided with a time where you needed the money, you were forced to sell, thereby missing out on some big returns that got made in 2023 and 2024. So a good way to look at this is look at all your requirements of money, look at your inflows from professional sources, and see whether there are any gaps, and then accordingly decide what you want to do with your investments. Last but not the least, do understand your investments carefully, especially because you have ratios which allow you to see risk-adjusted returns. Some of the more popular ones, like Trainer's ratio, Sharpe's ratio, etc., are published and therefore can be used for you to understand whether a return that is showing higher is truly fitting with your risk appetite or not. Because a return with higher volatility, even though it may be higher, may not be comfortable for you, and therefore a return which is a little lower but with low volatility may be more suitable for you. So all in all, please keep in mind that whatever you do, whenever you're investing in financial markets, you cannot eliminate risk. But what you can do is by being very thoughtful about the way you construct your portfolio and the way you manage your emotions, you can end up getting good outcomes if you are clear about what you're trying to achieve.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of Basel and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.